Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go over Twitter, see what's going on in that space. A lot of the stuff that I would cover is already being covered on it anyway. I know Platinum is breaking out, looks really good. We're going to obviously cover that. We're going to cover a bunch of other financial topics. I'm going to interject a bunch of my opinions that may differ or alter from others. We are coming to, I think, a point where things could roll over. We're starting to see some selling pressure in some of the sectors that we follow, and we could see a dip sell off for a little period of time, and then we'll get the wave three. That's what it looks like it might be doing. So let's dive in here. Let's get some other people's opinions as well, besides just mine. And I'm going to give you my opinions on their opinions, and maybe perhaps even give some examples if needed. So let's dive in here. If you want to follow me, it's at finding_finance. And if you want to join our community on the website, it's finding-value.com and use a discount in the coupon code. So Tavi says, the train is leaving the station. Platinum has decisively broken out from a 2-year resistance after closing at the highs of the week. This development reflects the building strength of the overall thesis for precious metals. For what it's worth, gold appears to be in a short-term consolidation phase before breaking out to all-time highs. So here's platinum. It is breaking out of this downtrend line to the upside. Platinum is the cheapest metal when looking at ratios, and I've been buying a lot of platinum since 2019, 2020, 2021. Anything below, I would say 950, I've been accumulating aggressively the past few years. Platinum, from a ratio perspective, is cheaper than, it's very cheap compared to gold, palladium, and silver. Whenever we see that type of alignment in the ratios of how cheap a metal is versus all of the other metals, that metal has generally outperformed over the next decade or decade plus. Palladium had that same setup in the mid to late 2000s, and that went up from about $200 was about the bottom, maybe a little bit less than that, all the way to $3,000. Rhodium also had that same setup. It bottomed in 2016 around $600-700, and it ran all the way to $30,000. It's used heavily in catalytic converters, and it's a very thin and tight market. Platinum's in the same situation. We're starting to break to the upside, and the ratios are screaming that platinum is the cheapest metal against all the other metals. Really good alignment, really good setup there. Here's Uranium Insider. Justin, he says, resource stock investing is not for the faint of heart. 0506, Denison Mines corrected by 47%. During the same period, the S&P gained 15%, and the spot price for uranium gained 60%. DML then tripled over the following 4 months. So you can see Denison Mines, we're getting all these corrective phases, 54%, 35, 39, 47, and then the big move. This is that up and down motion that we've been seeing is over here, and I think that we're going to have to get some sort of pullback here before a move on higher. So, yeah, that's what we've got. And commodity investing is really rough in terms of volatility if you're in it for the long haul. Here's a platinum breakout of the 20-year flag pattern. So this is looking at it from a bigger, longer-term perspective. This is a big boy pattern, guys. This is looking fantastic. Go platinum. Here's your pole. There's your pole. There's your flag here. And you've got a inverted head and shoulders, potentially, depending on how you draw the arc of the neckline. Maybe not. Either way, it's a low, a lower low, and then a higher low. And we're starting to break this upper trend line to the upside. This could be a very big move. Very big. I am locked, loaded, ready for this move. It's actually, I think, if you were to kind of break everything up, it's one of my largest positions. Silver's large, platinum's large, oil and gas is very large. Those are my big boys. Smaller positions, well, I've got a good amount in diversified mining companies too, but platinum is looking fantastic. Coming on down, looking at Revolution Capital. It says, I don't think people max long TLT get the below. The long end really can't go lower without reigniting the housing bubble. The Fed has to stick with higher for longer, even with unemployment going higher. And he says, buildings are taking price every month right now, while mortgage rates are still close to 7%. What's going to happen when mortgage rates go to 5%? Price is going to launch. This is for real estate. I actually believe exactly what this guy is saying. If interest rates were to decline, home prices are going to rocket higher. I don't think that the bond guys understand that they can't lower rates based off of the demographics that are coming into home buying years. They're going to have to keep them higher for longer. And they have to slow down that credit creation from the real estate market. And that's where they're trying to balance this all out. This guy gets it, in my opinion. Good work there. Market Sniper, he says, consider that a DDE is on its way of severe short, medium-term consequences. Rebuy the coming dip. And what he's responding to is uranium will likely not crash, Francis. The companies might still dump more, but U3O8 is in a supply deficit, not a surplus. You can cut gas and oil supply fast, but doesn't work the same with U3O8. This commodity cycles are longer and work differently, and it broke out last year. And he broke out, what he's saying is this green area, it's broken to the upside, and it's really starting to gain momentum. This is the price of uranium itself. So we've got a person here saying it's not going to crash. Market Sniper says it is going to crash. I am in the camp that we are going to get a short-term pullback for sure. I'm in Market Sniper's camp. I'm also in this guy's camp where there is a supply deficit. But I think there's something in the banking system that needs to get cleansed out of the system before we go higher. That is my intuition. It doesn't mean I'll be right. But right now, what I'm seeing in the charts agrees with Market Sniper. We're seeing larger selling pressure, not as much buying pressure. It just looks like it could fall and go ahead lower in a lot of the uranium companies. And that's why I don't talk about uranium companies a ton in the short term. Long term, I think they're going to do incredible things. So both these guys are right, but it's different time frames. I think they're both right on different time frames. Here's Goring and Rosenzweig. He says, we believe this is going to be the decade of shortages across multiple commodity markets. Backed by our research, we discussed the reasons why in this article, base metals, a decade of shortages ahead. And I read some of their thoughts about it, copper being the one in the near term here. And I agree. But again, the short term, if you get a scare in the banking system or if something happens, there could be a problem that wipes things out for a short period of time. And again, I'm not trying to time that market timing. I've got my money in there. I'm riding it higher. If we get a pullback, I'm going to see a pullback in the account, and I will buy more and cost average in. I will continue to do that as the price hits, hopefully, a low level and starts to come back up. So that's where my head is at. Now, other people, they're going to try to time this. They may be successful. Kudos to them. They may not be successful, and we may rip it based off of the supply-demand characteristics and the deficits in the market. Because the deficits are already here. The inventories, especially when you index them to the demand, have never been this low. So we've got conflicting forces going on in the short term. So another one of platinum. Platinum keeps on going, now shows a clear monthly breakout in progress. Bullish metals. Go platinum. Rip it, baby. Rip it, baby. Platinum, my boy Platinum. That's what I always say, my boy Platinum. So here's something that was kind of weird, guys. It says, as if home prices weren't affordable to begin with, Pay some more. The high FICO score fee, I'm not kidding about this, is $40 more per month on a $400,000 mortgage effective May 1st. It's the equivalent of bumping a $500,000 house purchased at 6.39% to $506,402. So it looks like they're charging people with high FICO score fees. I don't know what this is, what's going on here, guys. What are we doing? What kind of craziness is happening here? They're charging a high FICO score fee. All right. Michael Guyette says, breaking. I get things wrong despite conditions favoring the probabilities that favor the outcome. Where is your analysis? Anything I can review that shows you're always right. Wrong in outcome does not mean wrong in process. That is everything wrong with FinTwit. I agree with Michael Guyette. When you play the short term, all you are doing is you're playing the statistical probabilities. What Michael is doing, and I agree with what he's doing, 100% agree with what he's doing. He's saying the conditions here are ripe for something to happen. All right, for X to happen. It's a higher probability that X can happen, but it does not mean that X will happen. He's doing it based off of the probabilities of what he's done in research of what's happened in the markets. And guess what? No one is going to get it 100% right. No one. So he says, anything I can review that shows you're always right. And there is no one that's always right. This is why Peter Lynch, Warren Buffett, and all of the great investors, they don't trade in the short term because the success rate is not high enough for them. They take a longer term outlook, 5-10 years. They play the fundamentals, and then they try to buy when things are cheap. And the way that I do that is the same exact way. I buy when the conditions are favoring me. It is valued incredibly cheap, like platinum, and I buy it for a couple of years and cost average into it. And now we're breaking out to the upside. I'm going to make a bunch of money. That is how I do it. But guess what? It didn't happen in weeks or months. It happened where I accumulated this since mid to late 2019 and in 2020. So I accumulated for 4 years now. It's been 3.5 years maybe. I've been accumulating the heck out of physical platinum because I think it's the lowest risk, highest reward trade or investment in the market today. I did the same thing in palladium, and I waited over 10 years for that entire trade to play about. And it went from 200s all the way up to $3,000. And I traded everything I owned in palladium in April of 2020 to platinum. And I got lucky on that. The reason I traded it at that time is because I saw the premiums were low for platinum. And I was like, well, I don't think it's going to be any cheaper than this, and I don't think the premiums are going to go any cheaper. So I just happened to do it. Dow Gold equals. So I met a guy today, and he was bragging about how well he's done in Tesla. Suggested he might want to flip it for silver mining shares, in one ear and out the other. And he's got a shoulder potential and a potential fall for Tesla. Now, I know that charts aren't everything, but I do think they should carry some weight. What we're looking for is the alignment in the charting, alignment in the fundamentals, and alignment in the ratios. If you can get a full alignment, that's the highest probability of success that you can have. And you're going to have to be patient for that success to play out. That is how I view investing in general. Now, I tweeted Nick Gurley here. This is an opposite viewpoint that I have, and he's opposite on basically everything. And we think very differently. I'll just put it that way. All right. He says the fundamental problem in today's housing market is simple. Home prices are growing way faster than incomes. Real home prices up 102% since 1970. Real incomes up only 26%. Something changed starting in the early 2000s. And maybe he's right that something changed in the early 2000s, but incomes it's difficult because when a market goes into a shortage, your prices are going to grow faster than the average income. And if things get bad enough in the bond market money needs to leave bonds. And then where does it go? What does it invest in next? And there's a financial advisor that advises very wealthy individuals. And this was back where my parents were talking. They know some people with a lot of money, like hundreds of millions of dollars type money. And some of the advisors were saying, go buy a bunch of real estate and borrow to do it, and let the inflation eat it away. Because they don't want to go into bonds because it's basically a real negative rate, and they don't know where to put a bunch of money. And that was at least what someone had said as a financial advisor to some of these people that were very wealthy or are very wealthy. So let's go through his thing here. So this is home price growth that he's got. This is income growth, and he's comparing these two. So what he says is what changed was a huge drop in interest rates. The Greenspan rate cut in 2001 in an unprecedented era of low borrowing costs. Fed funds rate averaged only 1% last 20 years after being 5-6% before 2000. And voila, home prices go up above fundamentals. Now, here is something where I fundamentally disagree with him. I agree that we have low interest rates, but the way that he said a huge drop in interest rates, therefore home prices go up above fundamentals. That is what he's doing. I disagree because the demographic that came into home buying years is what drives interest rates. So he has it backwards, in my opinion. The fundamentals drive interest rates, not interest rates driving the fundamentals. He has it backwards. The demographic drives the fundamentals, and the fundamentals drives the interest rates. So when a larger demographic comes into home buying years, what that's going to do is it's going to drive home prices higher. And the interest rates are a byproduct of the credit creation of that demographic interacting with the housing market and buying new homes. So this here is a function of how many new homes are being built, and then an oversupply, and then a crash. We are still going higher because we don't have the supply to satiate the demand that is out there at this time. And interest rates are a function of that demand and the demographic and the fundamentals. You cannot have I'll say this, every time you get these gigantic home price growths, they will result in higher interest rates for the most part. For the most part. And if you look, you can almost say that this is a 1, 2, 3, 4, 5, 6, 7, and then we're going to get a huge bust up to the upside in, guess what this would be called? A Jesse Livermore accumulation cylinder to the upside. And this is also going to be the prelude of all the accumulation cylinders that we see in other assets and commodities and precious metals, if you want to know. And then you come on down, he says, now Powell has hiked the Fed funds rate back up to 5%, and a new era of higher interest rates is being ushered in. However, home prices have only gone down marginally, and in some cities are still going up. What gives? Well, let me give you my opinion here real quick. The Fed funds rate went up not because Powell has hiked those rates. Powell is being forced to hike the rates. He can't hold them lower because it's going to cost him too much money in quantitative easing to hold them lower. So he has to let them go up. The demographic and the housing market are forcing this to happen. The answer has to do with interest rate lags. We are now entering a year 2 of higher interest rates. After 2 decades of artificially suppressed rates, it's going to take some time to deleverage all of the madness that occurred in both housing. It's the demographic driving this, guys. It's the demographic. The reason this was artificially low is because the demographic did not support anything. Go check out Japan's demographic, the housing market, and check out their interest rates. They don't have the demographic to increase interest rates and to increase home prices. It's not there. It says, when I talk about real estate investors, most of them are still thinking like it's 2019 or 2021. They think higher rates are temporary and that there won't be bad economic consequences coming. So they still have a rosy view of things built off 2 decades of Fed bailouts. Okay, that's just an opinion. It says, but over the next several years, that mentality will shift. As more investors lose money on their flips, rent growth evaporates, and vacancies go up. Says who? Says who? That is all supply and demand. He says nothing about supply and demand. He says nothing about the fundamentals here. He just gives an opinion. As more investors lose money on their flips, well, what makes you think that investors are going to lose money on their flips right now? What data do you have that will for surely be an outcome? So then he goes, now some people disagree with me, like myself. They say that there's a housing shortage that will keep prices high. They base this argument off the historically low inventory levels present in today's housing market. Okay, he's spitting some game now. I agree with them. They are low, and I agree with what he says, a housing shortage, correct. So this is what he says, but rarely do people ask the important question, why is inventory low? Is it low because we haven't built enough houses? Yep, that's correct. Or is it low for some other more temporary reason? No, it's low because we haven't built enough houses. It says the reality is that we actually, so this is what his reality is. Nick's reality is that we actually have plenty of houses in America. The ratio of housing units to population was 0.43 in 2022. That's the highest level ever. The ratio of housing units to employment was 0.9 above the long-term average. Here's the problem, Nick. If this was the case, this wouldn't be the case. You can't take data, which is here, and then say, well, I don't care about the housing inventory data. There's more homes per population than ever. Okay, so where are they in the inventory? Where are they? There is a housing shortage because your inventory is telling you that. I don't care if some people have multiple homes. Those people have to sell those homes. And if they don't sell the homes and your inventories are low, well, guess what, Nick? You have a housing shortage. Doesn't matter. This information is irrelevant. So there's no structural shortage of houses, meaning that inventory is low for other reasons, like government foreclosure moratoriums, $5 trillion in money printing that made everyone feel rich. Opinion versus opinion. So let's just guess at what the reasonings are for that. Well, what about the demographic that's coming into home buying years? If that demographic never existed, guess what? You would have a bunch of inventory of homes. And guess what? If and we'll play the if game. If interest rates were lower, house prices would continue to go higher. Pretty simple. So then and perhaps most importantly, a record low 3.5% unemployment rate. I don't think the unemployment rate has anything to do with it. Unemployment rates usually go up during these types of market conditions, and so do home prices. It's 100% supply demand fundamentals. It says the trouble is foreclosure bans, people feeling rich, and 3.5% unemployment rate, all temporary deals. Okay, if that's what you say. And also a function of 20-plus year interest rate suppression. It's not 20-year interest rate suppression. It was the demographic that was not coming into home buying years. The Conference Board's leading indicator. Okay, I'm going to skip through this. Come on back. So next, there's not a single person entity trading physical uranium based on TA. Zero. No paper trades. No futures market. Shorter term trades are dictated by interest rates and the forward curve. But the primary movement of price is purely supply and demand. Here's the problem, though. Your demand is tied to your interest rates, your financial demand. And interest rates will determine where those money flows go. If there's a problem in the market, interest rates drop, money flows somewhere else, in particular into bonds, and away from commodities. And that could happen in a short period of time, in a short-term type movement. Shabam says, another week goes by and another week of onshore crude inventory draws as the world remains in an undersupplied oil environment. With demand rising and shale flatlined and OPEC cuts starting in 10 days, supply-demand fundamentals are set to tighten further as 2023 continues. So the barrel counters are definitely saying that we are tightening in demand. I'm a barrel counter too. But I also think that we could see problems in the market that could overwhelm the physical demand and hit the paper markets. So there's that in the short term. I do think that's a possibility. Platinum is hella strong today versus other metals and commodities. That is for sure. Now, this is still hanging out here, guys. And this is where I think the weakness could potentially be coming from. It says bank run in slow motion continues. Deposit at U.S. banks fell to $76.2 billion last week, even before tax payments, indicating the financial system remains fragile after a string of bank failures. The drop was mostly at large and foreign institutions, but they also fell at small banks. So this is the U.S. commercial bank deposits, and they're continuing to fall here. And that could be it could be a leading indicator of something. So that is something to watch. We've got cocoa breaking to the upside. That's looking quite strong. 9 months in the waiting. We've got massive move right around the corner for the entire precious metals complex. Platinum breaking to the upside. This one is Swiss franc divided by US dollar here, and it's starting to move higher. And what we see in some of these currencies is that the dollar weakens against other currencies during commodity bull markets. We are seeing this weaken. So this is the Swiss franc strengthening against the dollar. And we see that during these bull markets. In 2002, that happened as well. It went on up. And then we went into a consolidation period. And we're starting to break out again, the Swiss franc against the US dollar. This is generally when commodities outperform. The timing in the short term is difficult. The big picture view when we look at these things is absolutely rosy, and the sun is out shining on commodities. So in the short term, if there's still more fear, if there's things that sell off for a little bit, I think it could create what's considered a slingshot cheetah pattern. It gets everybody short, and then it's going to burn them to the upside. But your early movers are in precious metals, and we may have a little bit longer to go to the downside in some of these different commodities. Grady saying, getting messages from rookie traders in deep trouble who traded the last up move in gold. When markets do a trend reversal, it is vital to change mindset. One cannot trade a resumed bull with a bearish mindset and must ignore bias, emotions, narratives, and talking heads. Gold spot weekly. And go Grady. This guy's he's pretty good, guys. Gold spot, we've got the breakout here, and then you've got your back test, right? We could get a back test over here. We could move sideways for a little bit. We've broken to the upside, guys. This looks fantastic. This is your false breakout. This is the slingshot higher. This is the slingshot right there. This is happening in other commodities right now. Gold's our leader. Gold's broken to the upside. If we get short-term selling pressure in the market, I think it's going to be a buying opportunity and create a false breakout to the downside, getting everyone short on commodity stocks or equities or whatever. And then it's going to rip to the upside, and they're going to be stuck in that, having to cover, which is going to increase the buying pressure to the upside. That is your slingshot cheetah. Gold, it's already happened. Platinum's breaking out. Silver's breaking out. Everything looks good in precious metals. Those are our leaders. The other guys will follow after. And platinum breaking out of this flag, looking fantastic. More guys getting bullish on platinum. And that's what we've got here, guys. So that's what we've got for today. That's what we're seeing on Twitter. That's what's being shared. Lots of precious metals guys going ballistic, I guess. I'm one of them. I like precious metals. In all honesty, guys, I'm so ingrained into the fundamentals. I'm a hybrid. All right, I'm a hybrid. I like technical analysis. I like fundamental analysis. I'm so ingrained in the fundamentals. I think that the problems are so unsolvable in some of these areas that I struggle not to continue to buy on pullbacks. I struggle. I'm waiting to see if we can get a little bit more of a pullback in some of these areas in, say, diversified mining companies, in, say, oil and natural gas. But I want to fire off. I want to keep, buying it because it's so cheap and the fundamentals, it looks so good out in the future that I look in the long term, 5-10 years, and I see those fundamentals. And in the short term, yeah, I see the weakness in the technicals, but it's like, man, if you can buy when it's cheap, why does it matter if it goes down another 10, 20, 30%? Why does it matter if you know it's already cheap You're just getting better deals as it comes back. So my viewpoint is, well, I'll just cost average into what I think is the best opportunities in the market. And if the technicals also align with it, perfect. But the technicals align on the long term. They don't align in the short term. So we could see another kind of nasty spill to the downside or selling pressure. But I just don't get fazed by it. I don't know. I don't have that gene. I just look out in the future and I say the fundamentals are screwed for oil. They are really good for uranium. They're really good for precious metals, the declines in production of a lot of these different base metals, precious metals. They all look ridiculous, guys. Then you look at the big term, long-term chart patterns on the ratios. They're all cheap as heck, and they're all breaking to the upside. So why should I not buy it? And I can't see a good reason why someone should not buy something or cost average in if the fundamentals look incredibly good on the long term, and this is a big and the ratios are telling you that everything is dirt cheap. Yes, we're going to get volatility in the short term, and we could go down further. I'm in that camp. But I just look at this stuff from the big long term and I'm like, man, this stuff is cheap. I've been doing that with platinum for the past 3.5 years. I've been accumulating. I'm going to accumulate more oil and natural gas. So be careful what you listen to. Be careful for the reasonings that people are giving. Natural gas is lower because of the warm weather in Europe and the glut that has developed from that warm weather. It is not a sign that demand will be killed necessarily. That is reaching to some extent. But it could also align where demand does get killed, because the demand was already killed with the weather. So be careful you listen to. Make sure you got a long-term view, in my opinion. If you're trying to trade the short term, just be careful. It's based off human emotions in the short term. Fundamentals drive the long-term value and growth. But that's what I've got for today, guys. Give me a thumb up for the content. Subscribe to the channel. Check out the website if you guys like. Definitely sign up. 5 p.m. Mountain Standard Time. Question and answer session on Sunday. See you there, guys. This is Finding Value.